Welcome to Self-Growth Insights. Today, we're diving into the world of legendary investor Warren Buffett through the pages of The Warren Buffett Way by Robert G. Hagstrom. This book unlocks the secrets behind Buffett's unparalleled success in the world of investing. Join us as we explore the key principles that have made Warren Buffett one of the wealthiest and most respected investors of all time. Whether you're a seasoned investor or just starting out, this book has valuable insights to offer. So if you're ready to learn from the Oracle of Omaha himself, let's get started. Insight 1. Value investing. Warren Buffett is a renowned value investor, which means he seeks to invest in stocks of companies that he believes are trading at a price lower than their intrinsic or true value. In other words, he looks for stocks that are undervalued by the market. This approach involves a deep analysis of a company's financials and fundamentals to determine its real worth. Buffett believes that over the long term, the stock market tends to reflect the intrinsic value of a company. Therefore, by buying stocks when they are undervalued, investors can potentially benefit as the market eventually recognizes and corrects this undervaluation. Value investors like Buffett typically look for stocks with characteristics such as a low price-to-earnings (PE) ratio, a strong balance sheet, stable cash flows, and a competitive advantage that can protect the company's profitability over time. The goal is to buy these stocks at a discount to their intrinsic value and hold them for the long haul, allowing time for the market to realize their true worth. This principle of value investing is a fundamental aspect of Warren Buffett's successful investment strategy, and it has been a key driver of his long-term investment success. Item 2. Economic moats. It refers to competitive advantages that protect a company's profitability and market position over the long term. This concept is crucial in Warren Buffett's investment philosophy, and it is discussed in the book as follows. Economic moats are like protective barriers around a company, making it difficult for competitors to encroach on its territory. These moats can take various forms, and the book explores several types. 1. Brand moat. A strong brand can give a company a competitive advantage. Customers often choose familiar and trusted brands over newcomers, allowing the company to maintain pricing power and market share. Item 2. Cost moat. Companies that can produce goods or services at a lower cost than their competitors have a cost advantage. This can be achieved through economies of scale, efficient operations, or access to unique resources. Item 3. Network moat. Some businesses benefit from network effects, where the value of their product or service increases as more people use it. Social media platforms and online marketplaces are examples of companies with network moats. 4. Switching cost moat. When it's costly or inconvenient for customers to switch to a competitor, a company enjoys a switching cost moat. This can be seen in software or services that require extensive user training or data migration. 5. Regulatory moat. Companies in heavily regulated industries may have an advantage because new entrants face significant regulatory hurdles. This can protect established players from competition. 6. Patent or technology moat. Companies with proprietary technology or patents can maintain a competitive edge. This can be seen in pharmaceutical companies with exclusive rights to produce certain medications. Warren Buffett seeks to invest in companies that possess one or more of these moats. The presence of a strong moat indicates that a company has a sustainable competitive advantage, which can lead to consistent profitability and growth over time. By identifying and investing in such companies, Buffett aims to achieve long-term success in his investments. Understanding economic moats is a fundamental aspect of Warren Buffett's investment strategy, and it underscores the importance of assessing a company's competitive position when considering it as an investment opportunity. Insight 3. Long-term perspective. Warren Buffett is known for his patient and enduring approach to investing. Rather than seeking short-term gains or reacting to market fluctuations, he focuses on the following principles related to this perspective. Number 1. Buy and hold strategy. Buffett's investment philosophy revolves around the idea of buying stocks with the intention of holding them for a very long time, often years or even decades. He doesn't engage in frequent trading or market timing. 2. Minimizing short-term noise. Buffett understands that markets can be volatile and influenced by short-term factors such as economic events, news, and emotions. However, he believes that over the long term, the intrinsic value of a good business will be reflected in its stock price. 3. Compound interest. Buffett leverages the power of compound interest by allowing his investments to grow over time. By reinvesting dividends and letting his investments appreciate, he harnesses the snowball effect of compounding. 4. Tax efficiency. Holding investments for the long term can also be tax efficient in many jurisdictions, as long-term capital gains are often taxed at a lower rate than short-term gains. 5. Staying calm. During downturns, Buffett's long-term perspective helps him stay calm during market downturns and crashes. Instead of panicking, he often views these as buying opportunities, enabling him to accumulate more shares at lower prices. 6. Focus on business fundamentals. When taking a long-term view, Buffett prioritizes understanding a company's fundamental strengths and its potential for long-term growth rather than short-term market sentiment. Overall, the long-term perspective is a cornerstone of Warren Buffett's investment strategy. It aligns with his belief in the importance of owning high-quality businesses and allowing time for their value to grow. By avoiding impulsive decisions and short-term thinking, he has achieved remarkable success as an investor over many decades. Insight. 4. Intrinsic value. Intrinsic value is the estimated true worth or value of a company or an investment. It represents what a company is fundamentally worth in terms of its assets, earnings potential, and cash flows. Buffett believes that the stock market often misprices stocks in the short term, but over the long term, stock prices tend to gravitate toward their intrinsic values. Key aspects of intrinsic value in Buffett's approach include: 1. Financial analysis. Determining intrinsic value requires a thorough financial analysis of a company. This analysis involves examining financial statements, cash flow projections, and other relevant financial metrics to assess the company's financial health and future prospects. 2. Discounted cash flows. Buffett often employs discounted cash flow (DCF) analysis to estimate intrinsic value. This method involves estimating the future cash flows a company is expected to generate and discounting them to their present value. This helps him assess the potential return on investment. 3. Comparative analysis. Buffett also compares a company's financial metrics and valuation ratios to those of its peers and industry standards. This comparative analysis provides additional insights into whether a company is undervalued or overvalued. 3. Margin of safety. Buffett insists on buying stocks when their market price is significantly below their calculated intrinsic value. This provides a margin of safety, reducing the risk of investment losses if the market reevaluates the stock's price downward. 5. Long-term perspective. Intrinsic value assessment aligns with Buffett's long-term perspective. He believes that over time, the market will recognize the true worth of a company, and the stock price will adjust accordingly. 6. Incorporating growth. Intrinsic value calculations consider the potential growth of a company's earnings and cash flows. Companies with sustainable growth prospects may have a higher intrinsic value. Overall, understanding intrinsic value is fundamental to Warren Buffett's investment strategy. By estimating the intrinsic value of a company and comparing it to its current market price, he seeks to identify undervalued stocks with the potential for long-term appreciation. This disciplined approach to valuation is a key reason behind his investment success over the years. Insight. 5. Margin of safety. It represents the difference between the intrinsic value of a stock, the estimated true worth, and its current market price. This means buying a stock at a price significantly below its intrinsic value to protect against potential losses. Warren Buffett believes that it's essential to buy stocks when they are trading at a significant discount to their intrinsic value. Key aspects of the margin of safety principle in Buffett's approach include 1. Risk mitigation. The margin of safety serves as a buffer against potential investment risks. By purchasing a stock at a price substantially lower than its intrinsic value, investors reduce their exposure to losses if the market undergoes corrections, or if their analysis turns out to be slightly optimistic. 2. Investor's cushion. Think of the margin of safety as a cushion or a safety net. It provides room for error in judgment or unforeseen adverse events that could affect a company's performance. 3. Inherent uncertainty. Buffett acknowledges that there is inherent uncertainty in predicting a company's future cash flows and earnings. The margin of safety accounts for this uncertainty by requiring a larger gap between the stock's price and its intrinsic value. Therefore, risk-reward balance. The margin of safety helps investors strike a balance between risk and potential reward. By seeking investments with a significant margin of safety, they increase the odds of achieving satisfactory returns while minimizing the risk of significant losses. 5. Value-oriented investing. The margin of safety is a key principle of value investing, where the goal is to buy assets at a discount to their intrinsic value. This approach contrasts with speculating on short-term price movements or market momentum. Insight. 6. Quality over quantity. Buffett's investment philosophy emphasizes the importance of quality over quantity. He believes that it's better to invest in a select few companies that are exceptionally strong and well-managed rather than spreading investments thinly across a large number of stocks. Key aspects of this principle include 1. Thorough research. Buffett conducts extensive research and analysis to identify companies with strong competitive advantages, financial stability, and growth potential. He seeks businesses that he fully understands. 2. Reduced risk. By investing in high-quality companies, Buffett aims to reduce risk. These companies are often more resilient during economic downturns and better positioned to weather challenges. 3. Focus on fundamentals. Buffett places a strong emphasis on understanding a company's fundamentals, including its financial statements, competitive position, and management team. He looks for businesses with a durable competitive advantage or economic moat. 4. Avoiding over-diversification. Buffett believes that over-diversification can dilute returns and lead to mediocre results. Instead, he concentrates his investments in a small number of companies he has the highest confidence in. 5. Patient capital allocation. Buffett's approach to quality over quantity is tied to his disciplined capital allocation strategy. He allocates capital to businesses with the expectation of generating attractive returns over the long term. Insight. 7. Stock buybacks and dividends. Warren Buffett values companies that effectively return capital to shareholders through stock buybacks and dividends. Key aspects of this principle include 1. Shareholder-friendly approach. Buffett believes that a company's management should act in the best interests of its shareholders. Returning excess cash through buybacks and dividends is seen as a shareholder-friendly approach. 2. Stock buybacks. When a company repurchases its own shares, it reduces the number of outstanding shares in the market. This can lead to an increase in the ownership stake and earnings per share for existing shareholders. 3. Dividend payments. Dividends are cash payments made by a company to its shareholders. Companies that consistently pay dividends demonstrate financial stability and a commitment to rewarding shareholders. 4. Capital allocation. Buffett pays close attention to how a company allocates its capital. He prefers companies that reinvest in the business when opportunities are attractive but also return excess capital to shareholders when there are limited growth prospects. Number 5. Signal of confidence. Stock buybacks and dividend payments can be seen as signals of a company's confidence in its future prospects. Buffett views consistent buybacks and dividends as positive signs. 6. Income and growth. Dividend payments provide a source of income for investors, especially those seeking steady cash flow. Buybacks can enhance the potential for capital appreciation. 7. Tax considerations. Dividends and capital gains from stock buybacks may have different tax implications for investors, depending on their individual circumstances and tax laws in their jurisdiction. Great. Sustainable practices. Buffett prefers companies that have the financial strength to sustain dividend payments and buybacks without compromising their long-term growth prospects. Overall, the preference for stock buybacks and dividends aligns with Warren Buffett's value-oriented and income-focused investment approach. He appreciates companies that use excess cash wisely to benefit shareholders and build shareholder value over time. Thanks for watching. To dive deeper into Warren Buffett's investment wisdom, if you enjoyed this video, please like, subscribe, and hit the bell for more finance insights. Leave your questions or suggestions in the comments. See you in the next video. Happy investing!